Let's go back to the car. I'm saving money by changing one thing in this specially designed and engineered whole life. Every month, I'm putting money in. Every year, some of the policies, I'm putting money in, whatever. You're just saving whatever you were saving in the other sources. You didn't change the dollar amount you're saving. You just changed where that savings went first. So now I'm saving it up in there. And eventually, my cash value builds to be enough where I can actually take that money out and use it to buy a car. Okay, so now we're back to paying cash for a car. I've had to save the money first. Now I've got enough money to buy the car. So now what am I going to do? Follow along very closely because this is so simple and so logical that when I'm done, you're going to ask yourself, why in the hell haven't I been doing this the whole time? Why didn't somebody show me this? Because this is so easy. It's just such a brilliant idea. Well, when I saw this the first time in that 90-minute video, which you all can watch on my website, remember I sent you to the website to get the books. But why not watch the 90-minute video that I watched on my website to learn exactly how this works and see the numbers? You can check it out. Go to chrisnaugle.com and watch the 90-minute video that pops up and you'll see exactly what I'm talking about. So now I'm ready to buy a car and I go out and I find the car I want. So let's talk about the most recent vehicle that I just bought. Okay. It's a used, and I only buy used vehicles because I want that depreciation already out. It's a couple-year-old Mercedes G-Wagon. You guys have seen those big, ugly, boxy, loud SUVs. I've always wanted one because they don't depreciate as much, but they still depreciate. So what I did is I saved up the equivalent of about $68,000. Okay. Over time, it took me a couple of years to save that money up. And that's the problem. A lot of people are in such a hurry to buy a car. This might not work for your first car, but maybe you can start saving for the next one. So I saved up. Now, what I did is instead of taking a withdrawal from my private bank, which is that specially designed whole life, what I'm going to do is I'm going to take a loan. And now you're all thinking, oh, there it is. I knew there was a catch. Loan bad, loan bad. No. What if the loan that I take never needs to be paid back? Because I'm taking a loan from the insurance company. So here, follow along with me. I got 68 grand in the account. I'm buying a $68,000 G-Wagon. So I take a loan from my bank. Okay, for $68,000. I'm holding $68,000 and I had $68,000. So most of you, if I had $68,000 and I took 68, how much is left in my account? Most of you are thinking, duh, zero. You had 68 and you took 68. There's nothing left. Wrong. My account still has $68,000 in cash value in it. Well, how can that be? Whose $68,000 am I holding? Well, remember I said I took a loan. Well, who did I take a loan from? I took a loan from the insurance company. And they didn't ask any questions. I clicked the button. 36 hours later, I have $68,000 in my hand. But you're like, what's the catch? Well, there's two catches. Number one, where did that loan that they just gave me, does that have to be paid back? The answer is no. Well, who gives loans out and doesn't ask for them back? Insurance companies do, because the insurance company not only guaranteed that they were going to pay me an interest rate, a guaranteed interest rate. Okay. They didn't guarantee they were going to pay me dividends, but they have for hundreds of years. So now I've got those two things, but they also guaranteed that someday when I graduate, in other words, when I die, they're going to pay a death benefit out to my beneficiaries. And that's a promise and a guarantee inside the contract, just like the guaranteed interest rate. So all the insurance company does is they say, okay, you need 68 grand. We will gladly give you $68,000 of the death benefit that we're going to pay out someday, because this is a whole life. So it's for your whole life. So we know we got to pay it someday. We'll just give you 68 grand of that death benefit that you've got over here. And your money, the 68,000 that you've saved up, that's earning uninterrupted compound interest plus dividends, we'll just leave that money in your account as collateral. So your money just acts as collateral for the $68,000 that the life insurance company just gave you, which was an advance of your death benefit. And the insurance company charges you an interest rate on the amount that you have. But the interest rate they charge you is less than the interest rate that they're paying you. You follow? So I'm making a spread on that. So literally, I have money in my account. I took the money out. They charge me an interest rate, but the interest rate's lower than what they're paying me. So I'm making an immediate arbitrage. And the best part about that arbitrage is every single year, due to compounding, the one thing you think you know that you don't know or don't understand, due to compounding, every single year, I'm compounding on a higher amount. I might have had 68 grand that year, but it was 68 grand plus the guaranteed interest rate plus the dividend. So the next year it's compounding on a higher amount, and the next year a higher amount, next year a higher amount, next year a higher amount. So that spread, that arbitrage between what the insurance company charges me for the death benefit they advanced me and what I'm earning keeps working in my favor.